if you look at what consumers are up to, there have been a lot of concern that consumers would continue to retrench, trying to rebuild their balance sheets. But it does appear that consumers may be starting to suffer what some call frugality fatigue. That they in fact are going out to restaurants. I mean, I think if you go out to DC restaurants, they seem to be, I know they have a lot of politicians there, but on expense accounts, even lobbyists' expense accounts. But it does appear that if you go out to the malls, people are beginning to shop a little more, and you see that in most of the retailer results. So the saving rate, we think may be up a little bit this year. It was actually around 3% plus in the first quarter, maybe averaging 4.3% this year, but nothing like the double-digit rates we had back in the 1970s. In the meantime, it looks like the housing market will show at least some increase in building this year. You have very strong spending in terms of capital spending by companies who are now flush with cash. And the inventory rebuilding process is likely to continue to give some support to this economy throughout 2010. So the only real detractors from growth will be state and local government spending and also non-residential building. In terms of the history of recoveries, it is the case that if you look at the cyclical pattern, every time you have a sharp downturn, it's like a rubber band, you have a sharper upswing. As you can see here, we don't think this will be quite as strong as normal because you do have the headwinds, the tight credit that a lot of small businesses still face, some of the issues in terms of deleveraging by households in particular, but still we think it will be more of the cyclical rebound that you typically see, coupled with the fact that there is still a lot of stimulus in the economic system. The Federal Reserve is still being very accommodative, and although technically you would have thought that a lot of the stimulus that was pumped in by the stimulus package in early 2009 would have been expended, there's still out there a lot to be affecting the economy. It turns out that a lot of the shovel-ready projects were not really shovel-ready. For example, out in San Diego, there's a major hospital that's supposed to be constructed at Camp Pendleton, and the contract will not even be let probably until September at the earliest. So there's still, I think, a lot of this shovel-ready projects that are still trying to find a shovel. With respect to the pace and track of recovery, if you look at just sort of a moderate growth rate forecast, you find out in terms of the level of real GDP, by the end of this year, we will have recovered all of the ground lost and be at an all-time high. Now, I don't know if you had this experience, but if you talk to most normal people, that is, not economists, you find that they're saying, what are you talking about recovery? And of course, it will not really feel like a recovery until there are more jobs. But even there, it looks like the situation has turned and that we actually have seen layoffs bottom out. We've seen some pickup in hiring. If you look at temporary hiring, that's up significantly. It's not just the numbers. If you talk to any staffing firm, they're seeing a lot of activity in their shops. And that typically is a very important leading indicator. So we had pretty good job growth actually in the first quarter. We're going to get a big census bump in the second quarter. But by the end of the year, our forecast is that you'll be running fundamental job gains of a little more than 200,000 a month. This is below what you would see in a normal cyclical upswing, but should transform this recovery from what everyone has been calling the jobless recovery to a recovery that is actually creating some new jobs. It still will be 2013 probably before we get to the previous high of jobs as opposed to this year in terms of output, but at least we're making a start. The unemployment rate is likely to be down to around 9.5%, maybe slightly lower by the end of the year. Still too high to really save the Democrats here on the Hill, but at least providing some improvement. Now, with respect to inflation, the Fed has poured a lot of liquidity into the system, but most broader measures of the money supply are still rising pretty rapidly. Wage increases are pretty limited. You do find companies have stopped in general the wage freezes, granting some increases, but it would appear that you're still looking at an inflation rate that's pretty benign this year, averaging pretty close to what we saw last year. Now, with respect to the third topic, will the bulls or the bears now prevail in financial markets? The first significant chart to take a look at is, of course, the Fed's balance sheet. And here you can see the picture of basic explosion. The Fed's balance sheet is now over $2.3 trillion. The Fed would very much like to pare this back to where it was before Lehman exploded and get it back to somewhat below $1 trillion. It had stopped all of its special purchase programs, although it had to reopen the swap lines early this week. But it now would like to start to get rid of some of these non-treasury assets and not just allow them to run off normally as they mature, because the mortgage portfolio of about $1.25 trillion would take forever. So they're going to try to at some point sell some of those assets, although the timing and the magnitude is still very much up in the air. At some point, the Fed will actually start to tighten. Clearly, the Greece situation had scared them off from that tack in the near term, but it looks like there will be a three-pronged strategy after they get this sort of reduction in their balance sheet underway. First, they're going to be raising further the discount rate premium or the Fed funds target from its very small spread that has been prevailing for some time. Second, they're going to start to withdraw some of the liquidity from the banking system. And as you know, they're going to be actually experimenting with their new idea, which is basically issuing what they call term deposits, which would be CDs for banks, so that banks can go purchase this term deposit or the CD from the Fed, allowing the Fed to take some of the money out of the system. And I will tell you, I met with the California bank directors and officers last week, and they've been busy buying Fannie Mae and Freddie Mac and FHA, so they're interested in doing this. And then the final step will be actually raising interest rates. Now, the Fed funds target clearly is something the Fed keeps saying it's going to be low for a prolonged period of time. We think that by the end of the year you could see a higher level. We've got about 0.75% now. But I think the bottom line here, there may be a question about when, but there's no question about if interest rates are going to move higher. And we're telling all of our clients, either on the investment or the borrowing side, prepare for higher interest rates. An economic recovery, some risk of higher inflation, an ultimate Fed tightening, the size of the federal budget deficit, all of these factors argue for higher interest rates, if not this year, in 2011, particularly in long-term rates, where today you have the 10-year Treasury. Again, you have this flight to quality, but once that sort of simmers down, we're looking for 10-year Treasuries to maybe be 4.25% by the end of 2010.